In Las Vegas, shows once symbolized Strip success, with packed calendars, full theaters, and endless new premieres. Today, many productions are vanishing with little warning. They are being quietly canceled or cut short, while visitor spending slips and ticket demand softens. Resort operators have cited current conditions, yet industry analysts view these silent entertainment shutdowns as a flashing warning signal, because when shows fold first, the broader Vegas economy may face deeper trouble. What is causing this sudden retreat from the stage, and what does it reveal that the crowds outside still cannot see? Ticketed entertainment in Las Vegas stands apart from other casino offerings because it depends on visitors making advance commitments. Guests buy seats for a specific night, often weeks or months ahead. Unlike a slot machine or a dinner reservation, a show requires both the guest and the venue to lock in plans. For operators, this means reserving a theater, hiring performers and technical crews, and launching marketing campaigns well before the first curtain rises. These expenses are largely fixed, regardless of how many tickets are actually sold. Payroll for stagehands, lighting technicians, and front-of-house staff remains. Licensing fees for creative content are due whether the seats are full or half empty. Even the electricity to run the lights and sound is a steady drain, night after night. This sensitivity to advance demand makes entertainment a leading indicator of stress on the Strip. When visitor behavior changes, when tourists book shorter stays or hesitate to commit to a midweek outing, show operators feel it first. Weekday performances in particular are the earliest to show softness. Industry observers report that as soon as midweek seat sales start to lag, venues quietly pull those nights from the calendar, consolidating performances into weekends when demand is more reliable. The risk is clear. Every unsold seat on a Tuesday or Wednesday adds to the fixed cost burden, making it harder for a show to break even. Unlike hotel rooms, which can be discounted until the last minute or filled with walk-ins, show tickets lose value as curtain time approaches. There is no way to recoup the cost of an empty seat after the doors close. This dynamic encourages operators to be nimble, adjusting schedules, reducing the number of performances, or even canceling entire runs with little notice if early sales do not justify the expense. The decision to trim a show's calendar often comes before any public acknowledgement of broader economic trouble. It is a defensive move, protecting margins in the face of uncertain demand. The structure of the Vegas entertainment business ties its fortunes directly to visitors' willingness to spend beyond the basics of rooms and gaming. Shows depend on guests who are staying multiple nights, who have enough flexibility and budget to add a ticketed event to their itinerary. When those patterns shift, when trips shorten, or when the overall cost of a Vegas getaway rises, entertainment is among the first casualties. Operators face a clear calculation: keep running a show at a loss, or pull back and repurpose the space for something less risky, like a bar or lounge that can serve guests without the same level of advance commitment. The pattern of quietly cutting performances, especially on weekdays, is not just a business tactic. It is a clear signal that the Strip is feeling pressure beneath the surface, long before it shows up in hotel occupancy reports or casino win totals. Las Vegas visitors are feeling the squeeze. Data from the Las Vegas Convention and Visitors Authority show that June 2025 brought an 11.3% decline in visitor numbers compared to the previous year, with only about 3.1 million arrivals. Hotel occupancy dropped to 78.7%, down more than 6 points. The average daily room rate fell by 6.6%. Revenue per available room saw an even steeper slide, down nearly 14%. These numbers reflect more than just a seasonal dip. They suggest a shift in how travelers are approaching the city. The costs of a Vegas trip have become a sticking point. Reports from city officials and travel outlets describe a steady drumbeat of complaints: resort fees layered on top of room rates, paid parking at properties that once advertised free access, and food and beverage prices that now rival those in luxury markets. Visitors talk about $18 for a bottle of water, $35 for a basic hamburger, and a sense that every step comes with a new charge. One annual city report cited by The Street summed up the mood as fee fatigue, with guests feeling gouged at every turn. As these extra costs pile up, the way people plan their trips changes. Industry analysts and local coverage both note that travelers are booking fewer nights, skipping optional entertainment, and concentrating their spending on one big experience instead of several. The once typical pattern, a multi-night stay with a headline show, a second-tier production, and some spontaneous outings, has given way to shorter visits and stricter budgets. Midweek performances and secondary shows are first on the chopping block, as guests trim their itineraries to fit a higher all-in price. The perception of Las Vegas as a bargain destination has faded. Instead, the city is increasingly seen as a luxury trip, where every amenity comes at a premium. This shift is reflected in the numbers. In August 2025, visitor volume was down 6.7% year over year, with occupancy at 77.5% and room rates still sliding. A recent Tourism Outlook study projects that total visitation for 2025 will settle around 39.1 million, about 6% below the previous year. Recovery, according to analysts, is not expected until at least 2026. The impact of these rising costs goes beyond hotel rooms and casino floors. When travelers feel stretched, entertainment becomes the easiest expense to cut. The pattern is clear in traveler surveys and booking data. Guests now weigh the full cost of a Vegas trip, fees, food, parking, and tickets, before deciding what extras to add. As a result, show operators face a shrinking pool of buyers, especially for performances outside the prime weekend slots. The all-in price, not just the headline ticket or room rate, is shaping demand in ways that ripple through every part of the Strip's entertainment economy. Disco Show at the Ling Q stands out as one of the most ambitious recent productions to quietly vanish from the Strip. Spiegelworld invested an estimated $40 million to transform the former Imperial Palace Sportsbook into a new theater, steakhouse, and bars. The project opened with bold plans and high expectations, yet within months, weak ticket sales forced the show to announce its closure. The final performance in January drew fewer than 60 paid seats, according to seating charts cited by local outlets. Spiegelworld's Ross Mollison said ticket sales were the key factor in the decision to end the run. The closure landed with little fanfare, a subdued announcement, no major media push, and the theater's calendar updated to say no upcoming performances. The pattern is not limited to experimental concepts. At the Venetian, Freestyle Love Supreme, produced in partnership with Lin-Manuel Miranda, opened with considerable buzz, but wrapped up in less than 3 months. Industry coverage noted that even the draw of a Broadway name and a fresh format could not guarantee a sustainable run. The show ended earlier than its launch had implied, and the calendar quietly shifted back to dark nights and other events. Local commentary noted this was another example of the Strip's mid-tier offerings struggling to find an audience amid changing visitor habits and cost pressures. Long-running productions are not immune. Legends in Concert, a legacy fixture on the Las Vegas Strip for decades, ended its residency at the Tropicana ahead of the property's closure and redevelopment. By late 2025, the show no longer had a permanent Strip home. Industry reports group this exit with a series of other production shows that have recently gone dark, such as Bat Out of Hell, the musical, and Extravaganza. These closures were not accompanied by detailed explanations or high-profile announcements. Instead, they appeared as updates to venue calendars, brief social posts, or short notices that cited operational reasons or unforeseen circumstances. Festivals and large-scale events have also faced abrupt changes. Several music and arts festivals in the Las Vegas area were canceled or postponed, often with only vague references to production challenges or current conditions. Some immersive venues, heavily marketed in advance, were quietly shelved or scaled back before ever opening to the public. In those cases, ticket holders typically received emails about refunds or rescheduled dates, while public statements remained limited and non-specific. The trend is consistent across the Strip. Closures and schedule reductions are often handled with minimal publicity, short notice, and cautious language. Industry analysts and local reporters describe a wave of entertainment disruptions that rarely make national headlines, but that are well documented in venue calendars and trade coverage. These cases span new ventures, high-profile limited runs, and legacy productions alike. The breadth of affected shows, experimental, branded, and traditional, underscores that the pattern is not isolated to a single tier or format. Instead, it reflects a wider recalibration as operators respond to softer demand, rising costs, and a more selective visitor base by quietly trimming the entertainment slate. On recent earnings calls, executives from the Strip's largest resort companies have used language that leaves little doubt about their priorities. Phrases like cost discipline, margin protection, and disciplined cost management appear repeatedly in investor updates from MGM, Caesars, and Wynn. When asked about the future of entertainment, they point to the need for flexibility, adjusting schedules, trimming underperforming shows, and, if necessary, removing offerings that no longer justify their expense. The calculus is straightforward: fixed costs for a production show, venue leases, union crews, technical teams, marketing remain high even as ticket sales fluctuate. When demand softens, especially outside of weekends, the financial risk quickly outweighs the potential reward. This margin-first mindset has led to a pattern of rapid, often quiet, adjustments on the Strip. Operators now act quickly to remove shows that fall below profitability thresholds, sometimes with little public notice. The economics favor speed. Every week a show runs below break-even adds to the loss column. Rather than waiting for a slow bleed, management is incentivized to consolidate performances, shorten announced runs, or pull the plug entirely. Public statements use careful language such as current circumstances or operational reasons, but the financial logic is clear. Protecting earnings means shrinking exposure to high fixed cost assets when demand is uncertain. The next step is repurposing. Theaters that once hosted daily performances are increasingly being converted into spaces with lower risk and steadier returns. At the Link, Caesars invested over $40 million to transform the former Imperial Palace Sportsbook into a hybrid venue for Spiegelworld's disco show, complete with a steakhouse and bars. When ticket sales failed to materialize, the show was closed quietly, allowing the operator to reweight the space toward food and beverage, an area where revenue is more predictable and staffing is more flexible. Local and trade reporting in 2025 documents a wave of similar moves, showrooms reimagined as lounges, cocktail bars, or sport-centric hangouts. These concepts require less upfront capital, can be staffed dynamically, and capture revenue from guests who might hesitate to commit to a ticketed event but will spend on drinks and light entertainment. This approach is not limited to new ventures or experimental productions. Even legacy theaters and long-standing venues are being evaluated for their return on investment. If a space can generate higher margins as a bar or dining concept, operators are quick to make the switch. The rationale is reinforced by ongoing softness in visitor numbers and spending. LVC VA data for 2025 shows double-digit declines in visitation and hotel occupancy, with average room rates and revenue per available room also falling. Reports from city officials and travel analysts highlight rising costs for guests, resort fees, paid parking, and more expensive food and beverage, all contributing to shorter stays and more selective spending. For operators, the message is clear: discretionary entertainment is no longer a guaranteed draw. Protecting margins means being ready to pivot, often at short notice. The pattern of quietly shrinking show calendars and converting theaters into lower-risk concepts is not a sign of panic, but a rational response to a market where every square foot must earn its keep. As executives tell investors, the goal is to optimize the mix of offerings, ensuring that each venue contributes to the bottom line, even if that means fewer shows and more cocktails. Backstage, the human cost of these quiet show cuts comes into focus. For every production that goes dark or trims its calendar, dozens of workers see their hours shrink or their jobs vanish overnight. A production manager describes the scramble to reassign crew when a residency suddenly drops from 5 nights a week to 3 nights a week. Ushers, bartenders, and servers, many of whom rely on tips from packed houses, watch entire shifts disappear from their schedules. One union representative says that for tipped staff, every canceled performance means a night's worth of lost income, with some workers going from steady full weeks to on-call status. Grievances. Over last-minute schedule changes and reduced hours have multiplied, especially among crews who once counted on the predictability of long-running shows. The stories echo across the Strip. Workers are called in for fewer days, paychecks are thinning, and uncertainty grows about whether next week's calendar will hold. Behind the curtain, the pain of a quiet cancellation is measured in missed rent, thinner tip envelopes, and a growing sense of instability, even as the casino floors remain bright and busy. Industry analysts often caution against reading too much into a handful of show closures. They point to the natural churn of the Las Vegas entertainment calendar, where productions come and go as tastes shift and new concepts are tested. Some industry observers say the current wave of schedule changes and venue repurposing can reflect a healthy, creative refresh rather than a sign of systemic weakness. Major investments are still being made in headline residencies and large venues, and marquee acts continue to draw sellout crowds on weekends. According to a Travel Weekly tourism outlook, total visitation for 2025 is projected at around 39.1 million, about 6% below last year. Some forecasts expect a rebound by 2026 if broader economic conditions improve. The strongest shows, especially those featuring global stars or unique experiences, remain in high demand. For these observers, the recent softness may be a temporary response to high prices, tough year-over-year comparisons, and short-term consumer caution. Whether these entertainment cuts are a cyclical adjustment or the sign of deeper change remains an open question. That question will be tested as the Strip heads into the next tourism cycle. Today, canceled shows signal more than empty theaters. They reflect shifting priorities and tighter wallets on the Strip. As operators quietly pull back, industry analysts warn these moves often foreshadow deeper slowdowns in tourism and spending. The glitz can hide uncertainty, but empty seats rarely lie. What happens in Vegas now could echo far beyond the neon lights. Are these isolated business decisions or signs of a broader shift in how tourists spend money on the Strip? Share your thoughts.